let's like list the hierarchy here. Okay, you'll have senior debt. Okay, so this is increasing with seniority. Okay, this is the most secure person in the business. Okay, they're going to be the least likely to take any loss if things go badly. You're going to have, okay, and there's within senior, there's like senior secured, okay, where you're a senior lender and you have recourse to some specific thing the company owns, like a piece of real estate. Okay. Uh, some companies just have senior debt. They don't allow the debt holder to say, I got first dibs on this particular thing. Okay. So a lot of corporations um, will just have senior debt that's like kind of secured by everything that the company has jointly. There's like junior debt. Um, there's kind of like quasi debt, like convertible debt, which is more junior, convertible bonds. And you can say also like bank loans. They're going to be also senior here, which are, yeah. So this could be like senior. I'm thinking more of these being bonds. Okay. And then you're going to have preferred stock and then common stock. So let's say the assets of the company were like 100 and the senior debt, let's say, was 60 and then the common stock was 40. Let's say things went bad and you sold everything your company had and you only got 80 bucks. Okay. The first 60 are going to go to pay these guys off. So they're going to get made whole. So that reduces this to 20. And then these guys are only going to recoup half their money. So they take a 50% loss. Okay. So that's kind of how it would work. But in general, borrowers are taking less risk than the owners. Okay. The owners get to benefit when things go well, but they're also going to pay the cost if things go poorly. Okay. So that's kind of the general split between these two. And again, within these, there's also hierarchy. I guess that was my point of illustrating this. So this is kind of like where it cuts off. This is all liabilities, and this is all equity. Okay, so you can actually convert between these two. Okay, so an example is venture capital. Okay, uh, if you are a venture capital firm, and let's say you invest in some startup, and you're going to put in $20 million. So let's say the company is going to have cash, 20 million, and then there's going to have no liabilities. No one's going to lend them anything. Their equity is going to be uh, I'll tell you how it's going to be. It's going to first be preferred stock, 20 million, and then the common stock is going to be technically zero. There's like a way of accounting for this, but just to make this easy, it's zero. Okay. Let's say the company gets acquired. Okay. The owners of the company are going to let's say the company gets acquired for $1 billion. Okay. Um, at the onset, the venture capital firm has negotiated some percent ownership. Okay, let's say they're going to take 20% of the business for that $20 million. Okay, so when they initially make the investment, they're only entitled to get $20 million back. Okay, but What's 20% of a billion? 200 million. Okay, so would you, as a venture capitalist, rather have 200 million or 20 million, your original money back? What's better? It's obvious. Don't overthink this. You want the 200 million, right? So what they have arranged is that this preferred stock is convertible to common stock. Okay, because they're only entitled to this 200 million if they are part of this class. So they basically will convert their preferred stock to common stock, and then that will allow them to kind of get this big payday. Okay, let's say things go badly and you're only offered $5 million. okay, or 10 million. Let's say the company is like bought out for $10 million. Let's keep it simple. Let's say they're bought out for 20 million, okay? So the venture capitalist is only negotiated for 20% common stock, right? So what's 20% of 20 million? 4 million. So if they had only originally had common stock, they would have gotten 4 million, and the entrepreneur would have gotten 16 million of that 20. Now, does that make sense? Does that seem fair? That they put up 20 million, the company gets bought out for exactly how much they put up, but they're only going to get 4 back. Does that seem fair? Yeah, it's not fair, okay? And they know that, and the venture capitalists are not stupid. So that's why they have preferred stock initially, because if it's only sold for 20 million, they're going to keep it as preferred stock. They're senior, so they'll get all that 20 million back, and the entrepreneur will get 0. Okay? So they have the optionality to, on the downside, keep their stock senior and get all of the money because they're going to be the most senior shareholder. Or if things go really well, they'll convert to common. Okay? That makes sense? It's like a little real life applied example. So if you ever start a startup and you get venture capital, you'll see that they're going to have a different class of stock than you. Okay, they're going to have preferred stock, and you're going to have the common stock. But again, if the company does well, your common stock's going to be worth a lot, and they're going to convert.